The last section of the cash flow statement is cash from financing activities. Now, with the operations, we're looking at the income statement. With the investing, we're looking at the non-current assets. With financing, we're looking at how the business got the funds to buy those non-current assets, basically. So that's going to be our non-current liabilities. In this case, it's going to be the mortgage. Everything else here is a current liability. And it's going to be our equity section. Like, have the business received cash from selling shares, and have they, what have they been doing as well, like paying out dividends? So on this sheet, I have copied all the information I've got. I've got extracts from the statement of financial position, extract from the income statement, and some additional information. So first of all, we're going to start with the mortgage. The mortgage is quite often, any loans or mortgage are quite often really quite straightforward. So you just really need to look at, have they increased or have they decreased? So if they've decreased, it's been an application of cash because you've paid off some loan or mortgage. And if they've increased, it's going to be a source of cash because you've received additional cash from normally the bank. So in this case here, the mortgage has gone from 110 to 140. It's increased by 30, and so therefore it is somewhere we've had cash provided from, and it'll be the difference. So that's going to amount to 30. So it's really straightforward like that most often. Going into the equity section, it does get a little bit more complicated. We're going to start down here with this additional information. It says here that 20,000 shares were repurchased at a fair value at $3.40. So if we go 20,000 and we times it by the $3.40, that's going to give us how much cash that we've spent repurchasing shares. In this case, it's coming to $68,000. So under cash was applied for, we're going to put repurchase shares, and that's 68. This has an impact on our retained earnings account, because when we repurchase the shares, we don't necessarily repurchase them at the price we originally sell them for. That repurchase often comes out of contributed equity going down for the original sale price, but also though that share price of $3.40 represents a share of the retained earnings as well, that accumulated profit that can be attributed to those shares. So first of all, if we look at the contributed equity account, it's gone from 250 down to 200. Put the closing balance in here of 200. That there is going to be our share repurchase. So my workings, and that will be 50. Of that 60,000, 50,000 has come out of contributed equity. The rest of it must have come out of retained earnings. So that means $18,000 out of retained earnings. So I'm going to put this in to start off with. Share repurchase, and that's going to take my retained earnings down by 18,000. So it takes us down to 153 credit. Now, retained earnings is our retained earnings, so it represents our accumulated profit. So at the end of the year, that is where our profit after tax goes. Our profit after tax this year is $327. Gives us $480. Now, we know our closing balance for retained earnings is $286. So to get from that 480 down to the 286, this must represent the dividends that we've paid. So we've paid $194,000 in dividends this year. So under here, we've also got our dividends of 194. Just highlight those numbers that go in there. And so that is now the completion of our cash flow from financing activities. If we were to look at the final overall cash flow statement, this is what it's going to look like. We start off with our cash from operations, provided from, to, and then we're going to get either a net increase or decrease in cash from operations. We would really hope that that's a net increase. It should not be a net decrease. If we're operating in net decreases, we have some concerns about how our business is operating, particularly if it's an established business and it's operating and is a net decrease. So we're really looking for an increase there. Cash flow from investing activities, once again, provided from, applied to, and this will often be a net decrease in cash from investing activities. This is quite normal because we're going to be buying more non-current assets than what we're going to be selling them. And then cash from financing activities. So in this case, we received $30,000 in mortgage, but we have paid out in dividends and the repurchase of shares of $232. Now, if we get those net amounts, that increase of $371, decrease of $129, and a decrease of $232, we're going to get a net decrease in cash held, a net increase in cash held of $10,000. We add that to our opening bank balance, which is also 10, and that will give us our closing bank balance of 20. And we can do a check there against our bank under our assets and see how its opening balance was 10 and its closing balance was 20. So it's a little bit of a cross-check. Hopefully all work out. If it doesn't work out, it's a signal that you've done something wrong, but it could be one thing wrong or it could be 10 things wrong, but you'll need to go back and investigate.